Now we're going to talk about my favorite aspect of the Zaner360, using the hypothetical margin calculator. As an option trader, it's really important that you know at all times what your margin requirement is and what your margin requirement will be if you place additional trades or adjust existing trades. The best way to do that is through the use of the margin calculator, which you can find by going to the trading menu. You'll notice there is a margin calculator, and then below that there's a hypothetical margin calculator. I recommend that you use the hypothetical version, and the reason being it's a little more user-friendly, and it gives you the ability to add and subtract positions that are currently in your portfolio or some trades that you're thinking about putting on in a relatively easy format. If for some reason you don't have a toolbar at the top of your calculator, right-click and check Show Toolbars. Once you have the toolbar visible, you can easily import your current portfolio by clicking this arrow, the green and white icon. A word of caution, it does import your working orders. Those will be accounted for when you calculate your margin requirement. If you do not want them to be accounted for, which I recommend, you simply uncheck the boxes, and then you can run a recalculate by clicking the button. You can also easily add and subtract positions by unchecking them and then calculating. Let's start with the fresh portfolio. I'm going to hit the X button, which is delete portfolio, and that'll clear everything out. This calculator is most useful for option traders. Futures traders, they generally know what their margin is. The margin is simple. It's a straightforward single figure, and they know exactly what it is. It doesn't change very often. Option traders, on the other hand, they are provided span margin, which is standard portfolio analysis of risk margin, and what that means is it's based on a mathematical formula that incorporates volatility, strike price, all these sorts of things, and in a nutshell, it is a dynamic number. It's constantly changing. So if you're looking to find out what the margin is on a particular trade that you want to execute, you hit the green button with the plus sign, and then you search for your symbol. Luckily, I know that all option symbols start with an O, so let's try the E-mini S&P. We're going to do December puts. Now, as you can see, as I'm typing in the symbol, unfortunately, I have enough experience to know what the symbols are going to be without having to search for them, but there's probably a learning curve, so as you go, you'll notice that below the symbol that I'm typing in, strike prices will populate, and in theory, you could toggle up and down to find what you're looking for. Let's go with a December 1850 put in the E-mini. If it's truly selected and ready to go, you'll notice that all the contract specs will be on the right-hand side, and then I hit OK. By default, it shows this as being long, the 1850 put. As an option seller, we would want to change this to a negative number. If you're -1, that means you're short 1. If you're -2, you're short 2, so on and so forth. To determine what the margin would be on this position, we would hit the calculate button. Now you'll notice there are multiple figures here, and it's a little confusing, so let me explain those to you. First of all, you need to know the difference between initial margin and maintenance margin. The initial margin is the margin that you need in your account to put a trade on. The maintenance margin is the amount of money you need in the account to hold the trade. In other words, if you dip below the maintenance margin, you will get a margin call. You'll also notice that there is an initial risk and initial requirement. The difference between those two numbers is the premium that you collected. What that means is the initial risk is your net margin requirement. The initial requirement is your margin requirement plus the premium that you just collected. In this case, it's $225. So now that we know that there's a net margin and a gross margin, let's try to determine what that means. Really, honestly, they are basically the exact same thing. The only difference is the initial risk, which is the net margin, you're going to compare to your net liquidation value, which is this number. The initial requirement is the gross margin figure, and that figure you're going to actually compare to your cash balance. So if you were going off the initial requirement, you would compare this margin figure to your cash balance. In the end, whether you're on margin call or how much excess margin you have, it's all going to be the same as long as you're always comparing the initial risk to the net liquidation value or the initial requirement to the cash value. You might be asking yourself why they would give us both figures, and that's a good question. Most brokerage firms, if you notice on the bottom of your statement, they will choose one or the other. They won't give you both, but in the end, they all wash out to be the same. I recommend that you use the initial risk because it's just a little simpler to deal with, and you're comparing it to your net liquidation value, which is a more straightforward number. So with all of that said, we can see that the 1850 put, if we're a seller, will cost us a roughly $1,000 in margin. Obviously, if we sold 2, the margin would double. You might be wondering what the margin requirement would be if we changed our naked 1850 put into a credit spread. So let's say, for example, we decide we want to buy an 1800 put. We would change the quantity to 2 to match the short quantity and hit calculate. So if we purchase the 1800 put to protect our short 1850 put, our margin requirement is only $560. We'll just call it $250 a piece, $275 a piece. So obviously the margin is a lot cheaper if you buy the protection, but as we all know, protection isn't cheap. It's going to cost you a lot of money to purchase the 1800 put, so you're giving up your profit potential in exchange for lower margin and hypothetically lower risk. Let's go back to the actual portfolio in our account. So I'm going to delete this. And then again, we're going to import. Both of our futures positions have been offset at this point, so we're just going to disregard those for the purposes of this calculation. We are left with a spread in the Treasury market in the 10-year note, and we can quickly determine what the margin would be if we bought back our naked put, or what it would be if we sold our long call and just held on to a short strangle. We could also determine what the margin would be if we sold the covered call in the E-mini S&P. So let's change this to a long E-mini S&P future. And we're going to add a short at the money call, which at the moment has to be roughly around, we'll call it 2150. And by doing these calculations before we actually put trades on, we have a good idea of whether or not we truly do have enough margin to do what we're looking to do. Hopefully with the help of the hypothetical margin calculator, we'll be able to not only determine what our current margin requirement is, but be aware of what the margin requirement will be for new trades before we actually place them, and ideally give us an idea on how to manage margin calls should they arise. Thanks for taking the time to learn more about the Zaner360 platform. As a reminder, DeCarley Trading offers several platforms. In fact, we offer probably 30 or more trading platforms. So if the Zaner360 doesn't meet your needs, there are plenty others to choose from. But for most of our clients, the Zaner360 is the perfect solution. Not only is it free to use, but it's user-friendly and it's feature-rich. If you have any other questions or if there's anything else we can do for you, please feel free to contact us. In the meantime, visit us on our website, DeCarleyTrading.com. And if you're interested in learning more about trading futures and options, my latest book, Higher Probability Commodity Trading, is available at all major book outlets. It's cheapest on Amazon. Within the book, we talk about commodity market analysis, anything from seasonals to technicals to fundamentals, putting together, construct a trading strategy, and implementing a trading strategy, and more. If you'd like to contact me with any questions, comments, or concerns, you can either send me an email at cgarner@DeCarleyTrading.com. You can give me a call, or check us out on social media. My Twitter handle is @CarleyGarner. If you're on Facebook, search for DeCarley Trading and it should come up. Thanks again for your time, and let me know if you have any questions. I hope to hear from you soon.